Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show where we're going to break it into 3 segments. And in the first segment, we're going to touch on what's happening with Iran. You know, what we know that they have been talking with Europe. What does that mean? We're then going to look at how Russian flows are moving about. And we're starting to see a lot of these cracks in China and Chinese demand, which is what we've been talking about, but we wanted to put some numbers behind it. And then we wanted to look at what the draw, what kind of draw did we get in the U.S.? Is it something that's going to continue, or are we going to start to see some bigger shifts? You know, gasoline demand is back to where realistically it should be. You know, as we've been saying, it should be at about 9.1. It had an increase to 9.3. It should really come back down a bit. But again, we're right within the wheelhouse that we should be. But just to be clear, this is the week that some places start to go back to school, like the West Coast, the South. So that's going to put a weight on where some of the vacations are as that comes to an end. So we really are on the downswing in terms of where that growth is going to be. And as we had said, we thought that gasoline demand was going to peak that July 4th, which was, I think it was like 9.43 million barrels a day. We said that that was going to be the high for the year. And so far, even with this increase, that it still is the case. And one of the things that we wanted to call out before we get into the numbers for today were the exports. So when we look at what the U.S. exports were, and it had us at 5 million barrels a day of exports, I think anybody who's on the coast or who deals with crude exports, we physically cannot export that number. That we do not have the physical assets to load that many ships, nor do we have enough space to get that amount of crude into the market. It's very important to understand that there's lightering that happens. So you have the smaller ships that take it to specific locations where you can lighter, which is when you take crude from a smaller ship to fill a bigger ship and you make multiple runs, just because as there are parts that we can't access with VLCCs. So when all of that happens and when they're released at the same time, this is why we stressed it with the gasoline implied demand numbers. There's lumpiness. So you have to look at the 4-week rolling average, which is why we talk so much about it. And we talk about some of the noise that can come in. And we said last week that we had U.S. exports at 2.1 million barrels a day, insanely low. But as we said, that is not a right number. That's incorrect. But 5 million is also incorrect. So if 2.1 was incorrect and 5 million is incorrect, again, you have to average the two, which is why we talk so much about the 4-week rolling average to smooth out some of the lumpiness, because when was the paperwork passed? When did we have multiple VLCCs moving off the coast and being released at the same time? You know, these are the kinds of things that gets mixed into the data, which is why we do the show, to try to, again, smooth that out and really show some of that direction and where things are really headed over the longer term. So when we look at Iran's oil roller coaster, I think it's important to talk about what is happening with Iran right now. So personally speaking, I think that we will see Europe make some sort of deal. I think the U.S. won't stop it. We won't go in on the deal. It'll be something similar to what it was prior to 2015, where they were getting some oil. Not a lot, but they were getting some. It was going through but it was not something that was blessed by the U.S., if you will. So I think that is really going to be the case, where the U.S. is going to say, look, you can do whatever you want. We're not going to get involved, and we're not going to sign. But you have the ability to act on your own. Now, the one caveat in all of this was during the sanctions, a lot of the stuff, whether that be top drives, pipes, things of engineering, a lot of that was coming from Russia and by way of the U.S. So it went to the U.S. would bring it into Russia, and then Russia would take some of that equipment and send it to Iran. So now that Russia doesn't have U.S. and European equipment, and whatever they do have is in inventory and getting utilized, there's been less that they've been able to move into Iran to maintain production. So I think it's important to appreciate that they will increase. So if they sign a deal with Europe, there will be a bump in production. I don't think it's going to be on the same scale as it was, as you can see, after the signing with Obama, when it went from 2.7 million to close to 3.7 million. I think it's something closer to 500 to 600,000 barrels a day, and not that million. So, and just to give you an idea, a quote from something. So the European Union's views Iran's response to a proposed blueprint for reviving the 2015 nuclear deal as constructive, according to an official familiar, and is consulting with the U.S. on a way ahead. Now, I think the way ahead from the U.S. is going to be, look, you do you, we're going to step aside. The positive comments are the first sign that the Iranian position formally submitted by Tehran to the EU on Monday night might not further stall the negotiations. The official, who didn't want to be named, because who does, talks about how there's requiring more study. So Iran is producing about 2.5 million barrels a day right now. Following the 2015 deal, it took about 3 months to add 700,000 barrels a day and a year to get back to what their full capacity is. So the thing is, I don't think you're getting that 700 off the bat. I think it's probably closer to about 200 to 300. And then maybe you can get to that 700 over time. But with the issue with Russian supplies coming into Iran, it's going to be difficult to do that without getting around some of the sanctions, because even if the Europe lifts it, and as anybody who's been dealing in this space, it was difficult to get the U.S. equipment in still. So again, that's going to provide some sort of hindrance. So now when we look at China, here you can see that China's processed the least crude oil since March 2020 in July on maintenance, on a lot of slowdowns. So oil demand in China, the largest importer, is under threat as the government presses on with the strict, obviously, the zero tolerance on COVID. Among warning signs, total oil product demand may average about 14.1 million barrels a day this quarter, below the average of 15.7 in the same period last year, according to Kepler. Separately, official figures show apparent crude consumption sank almost 10% in July as refiners handled the least oil on a daily basis that month since March 2020. Now, one of the things that is going to be important, and we've been talking about it, especially in segment 3, we had a little bit of a ramp in refining, and now refiners are slowing down again, and you're starting to see more lockdowns, more pressure that's coming into, and a lot of it's in industrial areas, which is creating this feedback loop because they're just not importing as much crude as they were before. They have a lot in storage, and because of the issues that is happening on an economic level internally, you're just not seeing a lot of spending on an industrial side or a consumer side, which is going to keep that, I think, a bit sticky. China refined 53.21 million tons of crude in July, the least since April. The National Bureau of Statistics showed that's equal to about 12.58 million barrels a day, 6% lower than June, and the least since March 2020, which obviously you can see where it is right now. So that, again, you're seeing that pressure to the downside. We don't really think it goes much further. It's just we don't see a path right now over the next couple of months where you're going to get that big snapback, especially as we go into the winter months. We all know COVID spreads more in the winter versus anything else. And that's going to, again, create some of those issues as they face even more economic problems, which is going to reverberate through the system. So Russia's seaborne crude, 4-week average crude shipments from Russia by destination. You can see it's kind of leveling out, but Russia's seaborne crude have stabilized at a level about 500,000 barrels a day below the peak they reached after the Ukrainian invasion. On this basis, seaborne exports edged lower in the week of August 12th, slipping to 3.24 million barrels a day from 3.32 the previous week. So you're going to get, into that stabilized level. And when you look at Asia, that's where you've gotten just a little bit of softness. And as you continue to see China's buying remain fairly muted, that's going to also impact, because they were the biggest buyer and have been the biggest buyer coming into this period from Russia, and that's starting to really eat into those underlying flows, especially when you look at, again, where those volumes are going. So India is still consuming the same amount. That hasn't changed. But the yellow, which is that China piece, is where you're seeing it come down. And one of the things that we're saying is it's not going to continue to come down. We think it's going to find kind of that steady state. But as their overall demand, or the pie, is getting smaller in the near term, that's going to push more crude back into West Africa, and more importantly, back into the Middle East. And we're seeing a big spike in storage, floating storage in the Middle East, which is what we had said was going to happen based on those prices, the OSPs, where it just didn't make much sense. So that's where we expect to see more storage coming into both West Africa and the Middle East. But the Middle East side is the more concerning component. Russia's North European customers, not surprising to see a drop. That's what is being pivoted into Asia. And as China doesn't buy as much, that's going to just strand more crude in the water. And it's also going to create even steeper discounts, which should realistically be a benefit for India and other Asian nations that are willing to take in Russian crude. And then, as you can see here, the Mediterranean customers continue to stay steady state. This is where you could see the bigger drop as we get towards the end of the year, when some of those new sanctions really start to bite. This is going to be one to watch. And if China isn't buying more, where are they going to put a lot of this excess crude? Because they have to keep production going for fear of shutting it down, because they don't know if they could really bring it back online. So total crude oil and products, you can see that the deficit narrowed from 68.2 to 57.1, and that's oil and products. And to be clear, on the middle distillate side, everything's been fairly flat, while gasoline globally continues to build, continues to grow, creating some of these that mismatch. Total crude stocks, land and floating, flipped to surplus. So we're now back above the average from 2017 to 2019. So it went from a draw of 10.8 to a surplus of 700,000 barrels. Again, now that we have the U.S. with that steep drop of 7 million, we're going to kind of sit now within this fairly tight range, but floating storage is going up, which again is going to create some of these different problems that we've been talking about. While total oil product stockpiles, deficit widened from 57.3 to 57.8, but that's something that's going to continue to grind up on the back of gasoline as middle distillate continues to be in a fairly bullish backdrop. Now breaking it down, land storage, here you can see that the deficit narrowed from 53.9 to 53.9 to 49.6. And we see this saying fairly flat. And one of the things that when you look at the cloud, you can see that there's that fairly stable move down, and we just see that, again, the comps getting much easier. So we'll be back above 2021 levels and back within that lower end of the cloud. With west of Suez land storage, deficit narrowed from 33.4 to 28.6. With today's EIA number, that'll move back down. But again, you're seeing we're back within that cloud. We're back fairly back within this move because the comps have gotten easier. And then east of Suez, the deficit widened from 22.6 to 24.9, which based on what's happening in China, we do expect that to close the gap again. Now, shipments of gasoline to the U.S. from Europe rose in the 7 days ending August 11th, but it's still fairly low for this time of year, so it's not too much to see and on a changing basis. Floating storage, when we look at it, the surplus widened from 35.3 to 52.1. And this is on the back of west of Suez. Now, west of Suez and east of Suez, but the largest increase came on the east of Suez side when we look at the Middle East. So west of Suez, the flip to surplus went from negative 8.5 to positive 2.3. East of Suez, surplus widened from 43.3 to 45.5. And based on what we're seeing coming into the Middle East, we don't see that changing. Because of China's lack of buying, but at the same time, because prices have become uneconomic coming out of the Middle East, which will slow some of those exports. Now you look at crude stocks. Here you can see that there was a draw of 7.06. The 5-year average is now 47.1 below the 5-year, with that being driven by obviously PADD 2 and Cushing. So PADD 2 had a small drop of 260,000 barrels. That's 20.5 million below the 5-year, but Cushing had a build of 190,000. And as we were saying, Cushing is going to kind of just sit here. It's going to be the slow grind up. But then PADD 3 had the biggest drop of 7.49 million, which brings us only 6 million below the 5-year, with PADD 4 and 5 being fairly average. So again, the shortage still remains in PADD 2 and Cushing, with PADD 3 fairly normal for this time of year, even with this sizable export. And we do expect exports to remain fairly large, given the discount versus Brent and given the discount that we're continuing to see coming out of the Middle East, back to the reason why it's going to continue to be a problem. The SPR, factoring that in, there was a drop of 10.46 million, but that's something where we're starting to see those sales really start to slow down. Anas, I think, did a very good job of putting out a thread on just what that looks like. I retweeted it. I think it's worth reading. As we are seeing some of those sales slow down. The crude oil production, as we said last week, because of the pipeline leak, that we did expect to see some production fall down. That will come back. It's just a matter of timing. Some of it already started. It was just at a lower rate. So here you can see that we're down 100,000 barrels a day, but that's something that will come back as they are cleared to. So crude oil inventories for PADD 3, you can see that it's fairly normal versus where we were in 2021, where we were in 2017. So there's really not much to say one way or the other. It's, if you take out obviously 2020, that big yellow number, that big yellow line, we're perfectly in line with the 5-year average. So there's really not too much to say in the PADD 3 side. With Cushing, drifting back up, we're back above where we were in 2018. And as we were saying, we expect this to drift a bit higher and come a bit closer to, as you normally get that drawdown, we just don't see a drawdown. Everything's just going to be fairly stable. Runs fell 157,000 barrels, which is 0.8. It was on the back of PADD 3. We're going from 9.2 million to 9 million barrels a day of runs. Again, right in line with where we should be at this point a year in the year. We will go down a little bit more, but we should stay fairly stable until we get into September, and that's when you start to see those we come into key maintenance season, which is normally middle to end of September through October, and then you start to see those run rates go back up at the end of October into November. So not too much to say there. And here's where, when you look at it against historics, fairly in line with where we've been over the last 10 years. And now when you start looking at imports were down 39,000 barrels a day. And this is where you get kind of that backdrop between imports coming down into PADD 3. They were down 113,000 barrels a day. But when you have exports going out at that level, and not to say that it was the full 5 million, but you did have exports being sizable. A lot of these areas are one-way traffic, so that's going to hurt imports. And then PADD 5 being the lumpiness that we've talked about. PADD 5 was down 198,000 barrels a day. But as we said last week, PADD 2 was going to bounce. We had an increase of 123,000 barrels a day into PADD 2. And we just think that region is going to continue to see those elevated imports into the country. PADD 3 fell out of bed here. You can see it's made a new seasonally adjusted all-time low. This will bounce back, but again, it's not bouncing back to the 5-year average. It's just bouncing back to something a bit more comfortable. And again, that lower end of the cloud, but still nothing surprising. As we said last week, we expected PADD 2 to bounce back above the 5-year average, but stay within the cloud. Again, we don't see much changing within that region. Implied demand, you can see motor gasoline increased 225,000 barrels a day. Went from 9.1 to 9.34. One of the things that we said last week was we're either going to come down a bit or just kind of stay sideways. And our view was that it was going to be more of a sideways move here. Instead, we did get a little bit of an increase of 225,000 barrels a day. But our view is that 9.1 million is kind of where we should be. And if you look at ethanol had a build, blending stocks had a smaller draw than gasoline. which again just means that some of this is slightly overstated and it's going to come back down. And that's what we were talking about when everybody was panicking, when the EIA was printing 8.5 million barrels a day of demand. It's like, no, that's wrong. And if you ask people at the EIA, they said, yeah, that's probably wrong, but it'll catch up based on the way the data works. And here we are. It's a little bit of a catch-up number, and we'll settle out close to, again, that 9.1 million barrels a day. So if you see next week 300,000 barrels a day coming down in implied demand, it's not that people panicked and stayed home. It's just, again, the lumpiness within it. Distillate fuel had an increase of 201,000 barrels a day, getting closer to what we were saying of about 4.1 million barrels. Here it's sitting at about 3.9. Again, there's a little bit more upside. Jet had a drop of 178,000, getting closer to the top end that we've talked about of 1.55. And as we come into the end of peak vacation, that'll again continue to move a bit lower, with propylene having a bounce of 359,000 barrels a day. And again, that just is going to continue to be fairly stable. Now, when you look at gasoline applied demand, you can see that we're still below the peak from July 4th weekend, and we're still at the low end of where we should be versus the last 5 years. But again, this is, I think when you look at the economy, the way people are feeling, the way they're acting, the way they're spending, it's not surprising to see us, sitting at these levels. Then when you look at crude oil inventory in total, this is where you can see that, again, we're off the highs for 2022, but still fairly comfortable. And that's something that, again, it's going to waffle back and forth, and we will see some of that come back. Those builds come back. Days of supply for crude, fairly in line. It'll come back down a bit because we did get a draw, but we also did get a slowdown of crude, of refinery runs. But again, it's fairly stable, very sideways movement, nothing crazy there. Total U.S. commercial oil storage and products, we continue to be at a fairly sideways move, which is what, when you look at the rest of the lines, they typically get a steady move down. One of the things we've said is sideways. We're just going to continue to go sideways, making the comps a bit easier as we get into the end of this year. And then gasoline storage, here you can see that it fell back down. But when you look at 2020, when you look at 2017, when you look at other periods, there are periods where you get these big drops, and then you kind of go sideways, and then you start to come back up. We continue to believe that we're going to just have more of a sideways move. It's noisy because you have, when was it released? When did it get moved into blending? What were exports? When were they recognized? Because there's a certain amount of math that comes into it based on exports, with exports of gasoline that came down. But again, they were also overstated. Now they're probably slightly understated, and there's a mixture of just trying to smooth this out. So one of the things that we've said is we're going to continue to go sideways, even as you normally get a sizable drop in gasoline storage as we go into the end of September, beginning of October. Instead, we'll again come fairly comfortable into that side number. And when you look at blending components, the draw wasn't as big. When we look at gasoline, the draw was 4.64 million. When you look at blending components, the draw was only 3.28. So, and then you look at ethanol, there was actually a build. So again, it's just a matter of that balancing act. Then when we look at distillate, even though there was a small build, you can see just how far out of the normal we are. So there's no change in our view in diesel. It's going to be bullish in terms of pricing. And just think, this is without anybody turning on their heat yet. So once Mother Nature kicks in, you're going to see this become an even bigger problem. Jet fuel, very stable. We don't see things moving all that much. We're moving down along the seasonal lines, so there's nothing to show that we're going to adjust. The curve has continued to flatline with the belly coming down a bit, but you can see the front month has corrected. We expect to see a bit more of this flatlining, but as we had said, we thought that Brent was going to average about 102 into the end of the year. Brent is currently sitting at 92, so we do think that there is a bit of upside when you start looking at the math in general. I would probably say, and I was having this conversation with a friend of mine, that if Europe signs an Iranian deal, you'll probably get a big washout, and that would probably be the point that we would look to initiate a position if you wanted to play on the front end. While we do believe that the belly of the curve is a good spot. And then here you can see that floating storage has dropped. But given the dynamics, we will see this come back just a bit, but still remain at a fairly reduced number, probably above where we were in 2021, just given how low it is, but nothing, not like we're going to have this huge surge in storage as we have in other years. But again, this is just going to be that timing delay because we will see imports pick back up a bit into pad 3 as we come into this week and into next week. So that's what we have for you on the global side. And now in the next segment, we're going to go deeper into U.S. Demand and where we see things again closing out the summer and kicking off September.